How you doing? Welcome back. You've now finished the first module and the second module, and I'm sure in the last module on finding the house, shopping for the house, the inspection, the appraisal, you got a lot of ideas on how to check out a neighborhood, how to check out a house, how to talk to the neighbors. And now we're going to deal with the process that starts after you found the house. And you're talking about a different topic, which I affectionately like to refer to as the where's the money section. Shopping for your lender. How do you shop for a lender and a type of lender? How do you know what type of loan is best for you? How do you go through the loan process? What do you do? What are the things that can help you? That's what we're going to do in this section. So get ready. Next time you see me will be after the Section 1 quiz, and then we'll have a Section 2 quiz to close it out. So get ready to learn all about where's the money, how to find it, and how to get it. Now, see you back here at the time of the quiz. Get ready, have fun.
All right, let's start as usual by reinforcing the benefits and the reasons why we're here. We won't go into as much detail as we have on this particular slide, but you want to build equity, you want the tax savings, you want to take advantage of the longer-term investment value of an appreciating asset, and thereby build in the benefits of such an asset class. So with that, we'll get started, and we're going to go to the book, and we're going to move from the book to other resources just as we have before. And let's get started. Module 3, Shopping for Your Home. As we discussed, the first part of this discussion is around the lenders, shopping for your home and finding the right lenders. Now, first of all, there are various types of lenders that you can deal with, and we're going to describe all of them to you. First is a commercial bank, and a commercial bank is just what you expect it to be. They've got the name bank. They have all the familiar names. And so what's the difference between a commercial bank and a savings and loan or thrift institution? Most of the difference is historical, in that if you go back prior to around 1980s, banks were in the business of commercial lending, and each community had a savings and loan association that was primarily in the business of taking deposits and generating home loans to expand home ownership. After what we knew as a savings and loan crisis in the early 80s, the differentiation between some of the institutions was blurred. The banks were doing the things that the savings and loans were doing. Savings and loans were doing things that the banks were doing. So there's not a lot of differentiation today. Just know that some institutions are heavily focused on housing. Some institutions are focused on lending to businesses. Some institutions are focused on other things. And so you want to make your way to the housing experts in each one of these institutions. Now, mortgage banks is a specific type of bank that doesn't do anything except for mortgages. And they are firms that, for all practical intents and purposes, look and sound like banks, but they don't take deposits. They raise money through investors or by selling the loans in the secondary market, that which we'll talk about later. But all of these entities can offer you a mortgage, and they have different niches that traditionally they have served, and we'll talk about that a little bit more. Credit unions is different than other lending institutions in that, unlike the others, they do not have shareholders. They do not have a profit motive. The credit union exists for the good of its membership. It exists for a membership, and that is its core interest. It may be the teachers' credit union. In fact, credit unions began many years ago with teachers organizing an association to make it easier for them to get access to financial products. And so they serve a sphere of interest, and they are, because they have special tax advantages over the banks, they have typically not been allowed to engage in some of the commercial activities. And you'll notice now, though, some of the larger credit unions look like banks. They offer commercial loans, and in fact you'll see a lot of bank lobbying saying that if they are going to go beyond their community of interest, then they should be subject to the same taxation and regulations as banks, thereby eliminating a competitive advantage. One of the advantages that the credit union offers its members is because they don't have to pay dividends to shareholders, then all of those what would be earnings are passed back to the members in the form of lower fees, lower rates on loans, higher returns on deposits. Now, the credit union will also typically have a higher credit requirement, and we'll talk some more about the credit issues and why one would go to each of these institutions. Typically in the past, one would, if you were turned down by one type of institution, then you'd make your way to the mortgage broker, who deals with a plethora of institutions and can deal with whether your issue is credit, whether your issue is being self-employed, or some other issue that makes it more difficult to just walk in a traditional institution. And we'll talk about that a little more as we go along. Now, secondary markets. I talked a little bit about earlier about the selling the mortgages off, and the reality is that your bank has very little monies on deposit or on hand relative to the deposit obligations that it has. And in fact, when you are loaned money for your mortgage, 100,000, 200,000, whatever, that money is not the money of the lender who provided you the loan. That loan is packaged and sold to an investor who owns that loan. So let me illustrate. If I am the bank, you are my borrower. You borrow $100,000 from me. I take that loan and I sell that loan to an institution called Fannie Mae, Federal National Mortgage Association. You see it listed right here on page 51. There's also Freddie Mac, Federal Home Mortgage Corporation. They owned about half of the mortgages in the United States over the past few decades. And so when I lend you the money, I turn around and sell that mortgage to Fannie Mae, and I get my $100,000 back plus some fees, a couple of percents, because that mortgage is going to earn money over time. So I've sold it, I've made some money, and I've got that $100,000 that I'll lend to someone else. Okay, I lend that $100,000 to someone else. I sell that loan to Fannie Mae, get the $100,000 back, plus some fees and earnings for delivering that loan, and I can recycle that $100,000 because your local bank does not have enough cash to lend out to everyone in their local area. So that secondary market then provides the liquidity to the lenders to be able to lend. And there are a number of entities or government-sponsored associations, Ginnie Mae Government National Mortgage Associations. These are organizations that buy the mortgages from the bank, giving them cash for liquidity to lend to more people. So ultimately, the bank that you borrow the money from will not be sending you out your statements, and they will not be servicing, and except for a few cases of very, very large institutions service their own. Many of the banks service loans for the other banks. Some large servicing organizations service for many banks. So do not be upset if you get your loan from XYZ and your payments are coming from ABC. You'll get a letter explaining the transfer. You'll get a letter explaining, and if you've had a car payment, you've probably already experienced, you're making your payments, and all of a sudden that loan is sold to someone else and your payments are going to a different address. Now, the thing that you need to understand is whatever is in your agreement that you signed up to, that agreement still stands. No terms of your loan change because the ownership of the loan changes hands. No terms of your loan can change because it's being serviced by someone else. When you sit down and you enter into an agreement for a specific rate, for a specific payment, for a specific time, that cannot be altered other than you sitting down and signing a new agreement. So by law, when these things are sold, the terms of your agreement must continue to be honored. Okay, so that's an important concept, so don't be alarmed when the names change. That's just a matter of how the industry operates. Okay, now the other thing that I want to talk about on this page that you'll see on subsequent pages, okay, is the Federal Housing Administration and the Department of Veterans Affairs, the VA. Federal Housing Administration and Department of Veterans Affairs are parts of the U.S. government, and the way they do not lend money. They are not lenders. They are not servicers. What they do is they insure mortgages or guarantee the mortgage or back the mortgage up, and thereby reducing the risk for the banks and expanding home ownership in the United States. And the government does a lot to ensure home ownership because, not just because it's good for taxpayers, not just because there's tremendous socioeconomic differences for homeowners versus people who are not homeowners. If you look at the statistics, the homeowners are going to grow more wealth because of the equity considerations that we talked about earlier. The children of homeowners are less likely to encounter the legal system. The children of homeowners are more likely to be homeowners. The children of homeowners are more likely to be educated. So a lot of positive things correlate with homeownership. Not only that, but it's terribly important to the economy. Every time a dollar is spent, it replicates itself in the economy 9 to 12 times, and thereby helping the economy. How does that happen? When you buy the house, that $100,000, well, then a payment goes to the contractor, the realtor, and those people go to Publix, and Publix pays its employees, and those employees go to Walmart, and Walmart pay their employees, and so that money keeps moving throughout the economy. So it's terribly important to the economy to keep home ownership and home buying happening. So that is one of the reasons why we have the government participation in the market. Now, I am going to talk to you a little bit about conventional mortgage and insurance products. Now, typically, as it says right here at the top, traditionally a homeowner needed 20% down payment, okay, and finance the other 80%. Well, through organizations and facilities like the FHA and VA, then the FHA allows homeowners to buy a home with 3.5% down, and a little more liberal credit requirements. So thereby opening up the possibility of home ownership for more people. About a third of the mortgages in the United States right now are FHA mortgages. Those people, in all likelihood, especially the new purchasers, would not have had the 20% for the traditional product, and so thereby offering more people the benefits that we talked about earlier. The VA, one of the benefits for serving in the military and crawling under barbed wire and sleeping in ditches, is you can actually buy a home with zero down as a veteran, because your home purchase will be guaranteed or sponsored by the Veterans Administration, thereby reducing the risk for the lender and expanding the pool of people who will qualify for home ownership. Now, the thing that does is it allows people who would not have traditionally been in the ownership pool to get in the ownership pool. Now, further, we've got various and sundry programs offered by Fannie Mae and Freddie Mac. You've got programs that offer you 3% down, and depending on the timing and in the cycle, you will see products that are 100% zero down offered by Fannie and Freddie. Now, you're all aware that we have had a financial crisis in this country in the past decade. And so lending got much more conservative, and we saw some of the liberal products tighten up and be less available. We're seeing them loosen up now, and they're being more available. So you'll see a variety of products available to fit your situation with low down payment. And I'm focusing on the low down payment, first-time home buyer. Upfront cash is typically the most arduous issue, and so you can shop for a mortgage program that allows you for a lower down payment with flexible credit requirements, and which brings me to the next issue that I want to talk to you about is private mortgage insurance, which is listed here. Now, private mortgage insurance, what is that? That's not life insurance or health insurance. It does absolutely nothing for you. It is an extra premium you pay to protect the lender against risk because you didn't have the traditional down payment of 20%. It is an additional payment. In the case of FHA, it's been 0.5% per year, divided by 12, added to your payment. So when you don't put the 20% down, you get to pay a little bit extra, but it still allows you with a limited cash position to enjoy the benefits of leverage and home ownership as we talked about them previously. And then you've got government financed and insured programs, FHA, a part of HUD we talked about, and we're going to talk some more about how these features work, how mortgage insurance works, which we just talked about a little bit, and how to find an approved lender. And as it points out here, on the HUD website, hud.gov, you can find lots of information about the process, about who the lenders are, about your qualification and application, which we will cover, restrictions, which we'll cover. So here are the information sources. HUD.gov, excellent place to start. Fannie Mae, FNMA, Federal National Mortgage Association. You go to their website and you'll find information reinforcing anything that you've been told by any lender or person in the process. It's documented by these organizations. And so as we've talked about, you really want to be armed and informed. We talked about the Veterans Administration, rural housing services for rural housing outside of agricultural areas. There are special loan programs. The Farm Bureau has a specific program that is for more rural areas as well. And also various programs that begin with the federal government are administered through the states and down through the state and local governments. So you want to make sure you are aware of down payment assistance programs that are administered through the state, usually further administered through your local housing services. Whatever your municipality, they should have a housing services. If you go to their websites, if you go downtown and check out housing services, you'll find out that they tend to administer the down payment assistance programs for low to moderate income buyers, administered through the lenders, for various and sundry programs for whatever is available between the state agencies and your local housing services. You can inform yourself of what's available, when it's available. Frequently, the programs that are administered through the state, the down payment assistance programs in particular, tend to be funded in September when the new fiscal year starts, and they're available until the money runs out. So you really want to be aware of those and do your homework and find out if you qualify, find out where you are relative to the median income in your area. Typically, if you're below 80% of the median income in your area for your family size, you'll qualify for various assistance programs. And you may qualify for some things that you don't think you do. So go ahead and check it out and be prepared with real information. Now I am going to shift gears and I am going to walk you through a presentation on the credit issues. Now, credit and home buying, you'll see the orange and green, bad credit burns money motif. That's a book that I wrote on credit several years ago. So yes, I wrote the book, or at least a book on credit. And the thing that I'll start with is the understanding that, as we've discussed, most of our money problems are not money problems, but they are manifestations of underlying behavioral problems. So we're going to spend a lot of our time talking about budget and behavior. You talked about budget ad nauseum. We've had all the implications and the behaviors that go associated with budgets out of control and in control. So we're going to be focusing on the spending behaviors and the credit behaviors and what impacts your credit and credit report in this section. So just to illustrate, all the ideas around lending and approval actually end up being very, very simple. And the simple question is, if I lend you my $100,000, $200,000, am I going to get it back? Not only am I going to get it back, but am I going to get it back as agreed, on time, as we agreed to? Now, we all have relatives. And you can see by the slide, we have a contrast between Cousin Bobo and Aunt Flossie. Just the name tells you there's a behavioral difference. Now, Cousin Bobo, in some cultures, it'll be Cousin Bubba. And my Hispanic friend tell me in the Hispanic culture it'll be Cousin Pepe. But in our culture, we have some cousins who are unreliable, and their history says that they're not going to do what they're supposed to do. And if they borrow some money from you, you're not going to see it back. And so, and quite frankly, we love Cousin Bobo. And we knew he didn't pay us back the last time, and I frequently ask people in classes, well, if he comes back the next time, is he going to get the loan again? Everybody says no, but we know a third of us are going to let him have it again because we're soft-hearted. We love him. Now, by the third time, even the most soft-hearted people are going to say, look, you got a history. Don't come calling. You're not getting anything out of me. Now, contrast that with Aunt Flossie. Yes, Aunt Flossie, if she says she's going to pay you on Friday at 6 o'clock or so on Friday, you're going to get a knock on the door and she's going to have your money. If the car breaks down, she's going to catch a ride to give you your money. But she is going to live up to her obligations. So the next time she needs something, she doesn't need to offer any explanations. All she needs to tell you is when she's coming back with it. That is credibility. That is what credit is. Good credit is good credibility based on your past behavior. Okay? That's just that simple. Now, the spectrum of scores, really theoretically 300 to 900. Now, you can see the range of, generally, if you're over 700, you're considered good credit, and you'll probably get good terms and get what you want. And we're going to dimension that some more. And quite frankly, traditionally for home buying, the dividing line for getting a good mortgage versus what we refer to as a subprime mortgage or a less attractive deal, not just in mortgages but in just about everything, is that 620 line. Below that number, there's a reason you have a number below that number, and the only acceptable reason is that you got what we call a thin file. You're 18 years old and you've just got no history, and you may have no score, but you won't have a low score. People frequently ask, is no credit better than bad credit? Bad credit is worse than anything. No credit is not the same kind of issue. No credit just means I haven't borrowed any money. It just means that, and it frequently in the process, It's easier to present someone with a thin file because they're not a risk, because they're not out borrowing a lot of money. And they also tend to have other compensating factors that don't show up on the credit report. And I'm getting ahead of myself. So now, once you're down below that and you're down to the 580, there's a reason. You didn't wake up with a 580. There are some reasons. Now, let's go to the next slide and illustrate it a little bit more. Now, again, go start from right to left. The Fannie Mae, Freddie Mac mortgages. You can see this is copyrighted 2006. I've been using this presentation for 10 years, and all the truths contained herein have been true for those 10 years. They've been true for a generation, and they'll be true for your children's generation. The interest rates are changed because rates were in the 5 to 6% range at that time, and now they're in the 3% range, but the relative comparisons remain the same no matter what period, no matter what the prevailing rates are. To the right, your good quality mortgage is going to have no late payments. You're going to have a rate. Your down payment will vary from 20, 10, 5%, maybe even 0%, depending on the quality of your credit rating and the timing and the overall market cycle. Now, the FHA VA is not credit score driven so much as it is determined by your most recent history. Your credit history follows you from cradle to grave. Now, your score doesn't stay the same. Your score goes up and down over time based on your behavior. And I spent some years working in credit scoring, so I can tell you that the way the formula, the algorithms work is the recent past is weighted much heavier than the distant past. So if 5, 10 years ago you were jacked up and you changed your behavior, you paid those delinquent balances, you've got a good history of positive stuff, and we'll talk some more about that later, then your distant past doesn't have to control what you have access to now. You've got no late payments in the last 12 months, any collections, judgments, or zero. Now, what's a collection item? A collection item is when you haven't paid, okay, and your debt is written off, sent to a collections agency. Usually after about 90 days, your bills are usually payable on a 30-day cycle. 30 days late, 60 days late, 90 days late, and when it gets to a certain point, then the creditor says, this person isn't going to pay. I'm going to write it off, sell it to a collector, send it to a collection agency, and maybe they can collect on it. And to look a little further, as you move to the right, as your scores drop, the B credit probably has 3 30 days late and 1 60 days late. They're going to pay a higher rate and higher down payment. And the C credit's got more 30 days late. They've got more 60 days late, and they are going to pay for those past indiscretions. And you can see the C credit compared to the B credit compared to the A credit. The A credit over here has no late payments. The B credit has late payments, and you will pay more. So now, and traditionally, just about everybody can buy a house, but it's whether or not you can get favorable terms that make sense. Because someone down here in the D credit can get a house if they've got enough cash and they're willing to pay credit card types rates for their house. Now let's take a look at what that translates into, because it is quite substantial a difference. Okay, and so as we look here, on those prevailing rates, you can see the relative difference in payment between what kind of mortgage you get based on your credit quality. The best quality credit, reasonable deal, very good deal. And as you move over, you pay for the indiscretions of past bill paying behavior or the lack thereof. And it's not just with the house. You'll see this with cars. You'll see it with the credit cards. The people with these credit cards, these are getting 0 offers, 0 rates, balance transfers for a year. These people are getting higher rate offers, if they're getting offers at all. These people are getting taken advantage of in the credit markets. And as long as your past bill paying behavior says that you are a high risk, you will have the benefit of paying more. Now, let's take a minute and talk about the credit report itself. You have a sample credit report, and I'm going to put one up on the screen, and we're going to walk through the various components of the credit report and what they look like. Okay. Now, what I have here in front of me and in front of you is a document produced by Equifax, sample credit file, and I'm going to walk through the sections and tell you what's in it and how you take care of it. Your personal information is going to be the first section. Okay, and you want to, when you pull your credit report, about a decade ago, law passed that says you're entitled to a free copy of your credit report once a year from all 3 agencies. The credit bureaus, and when we go back to the book, we'll see this. There are 3 primary repositories of credit information in the United States: Equifax in Atlanta, TransUnion in St. Louis, and Experian in San Diego, formerly TRW. I almost said TRW. So those 3 credit bureaus are required to give you. You used to have to pay for a copy of your credit report, and you used to not be able to get your credit score. And as a lender, the credit bureaus actually, first of all, the credit scores is an algorithm that is created by a company called Fair Isaac and Company. And Fair Isaac and Company created a guy named Bill Fair, helped write the Fair Credit Reporting Act, and created this credit scoring. And the credit scores that are at all 3 bureaus are derived by Fair Isaac. So if you hear your Beacon score, it's the same thing. If you hear your Equifax score, or if you hear your Experian score, they're all the same 3-digit numbers. Now, each of the 3 bureaus will return a slightly different number. You won't be a 700 at one and a 500 at another, but you may be a 720 at one, 710, 740 at the other. The reason being is because they don't all have all the same information. The people who lend you money subscribe to the bureaus, and they send the information in, and it's housed in that repository. And that if you're in the Southeast, chances are Equifax will have the most information. And in fact, one of the things that happens with people is when the lender pulls a credit report, they don't pull all 3, they'll pull 1. And then as we're going through a more detailed process, which we'll talk about later, we pull all 3, find other information, and you hear that things popped up. Well, it didn't pop up in the process. It was already there. Make sure when you look at all 3 repositories, get the complete picture of your information so that you know what lenders are looking at when they look at you. So from the personal information, if it is incorrect, then you can contact the credit bureau through online or in writing and correct that information. Public records information, some examples of public records information, that's things that are filed at the courthouse. If there's a lien against you, that means that somebody went to court and said, you owe me money, you're not paying me, and I want the world to know that I've got the right to collect from you, so that before I lend you some money, if I've got somebody out there with a lien that says, they're chasing you down for their money and suing you for their money, I'm obviously not going to lend you money. Bankruptcy was provided in the federal code. It's basically a start over. Lots of examples. Guy falls off a roof, can't work for 6-9 months, spent 3 months in the hospital, bunch of hospital bills, house payments behind, everything is behind. This poor soul will never work out from under that. What the bankruptcy code is that we can go to the court and say, no mas, I can't handle it anymore. Wipe me a clean slate. start over. And there was a time when you had to go to debtor's court, debtor's prison. You couldn't pay your bills. You went to debtor's prison, and your family had to bring you food. And we actually, if you could go look it up, we actually had 2 presidents that went to debtor's prison. So fortunately, we don't have debtor's prison anymore. We just stress you to death. And we do have the facility in the bank, in the federal laws, to go to court, have your record wiped clean. The creditors lose some money in the process, but then you can start over, and can't do it again for 7 years, but it does allow one to have a new start. But it does go on the public record and stays out there on your credit report for 10 years. Satisfied judgment. A judgment means that you owed me, you didn't pay. I went to court, sued, and got the right to come after you and take something of value, repossession. But I've got a judgment. Judgment says I went to court and the judge said, you're right. You have the right to go and collect from this person, and it'll go in the public records and it'll end up on your credit report. So you can run, but you can't hide. Okay, especially in today's world with the electronics, there's nowhere to hide. Collections agency, we talked about the fact that a collections agency exists to chase you down and get money out of you for your unmet obligation. If someone sends it to collections or sells the account to a collections agency, it will be on here. As you can see with all of these, it shows when it was reported, when it was assigned, who it is, the phone number, the amount, whether it's a hospital bill, unpaid balance, date of last activity. Same thing with the judgments. It shows when it was filed, where it was filed, case number, defendant, and the amount and dates. Bankruptcies, same things, how much assets were charged off, liabilities, right there on the credit report for the world to see. So you really want to manage these issues because they do not just go away on their own. Okay, now then we've got specific listings of your accounts on your credit report. It will show a listing of each type of account that you have had going back as far as you go. And each column, you've got the company name, the account number, who's the account, whether it's a joint account, whether you are authorized user, or whether it's an individual account. Authorized user is if I got a credit card and I give my son a copy of the credit card and he can use it, they issue him a card, it'll show on his credit report that he's an authorized user on mine. Be careful, because you're an authorized user on somebody's credit card and they don't pay on time, it's going to show up on your credit report looking like that. Okay, so you really want to take a look at your credit report and verify what's out there. The date opened, how long it's been opened, date of the last activity. So if you haven't been using an account or you close an account, it'll show when it was last used. A high credit, that was your high credit limit. The terms, the number of months. Okay, in the case of a revolving loan, okay, you've got on an auto loan, okay, you've got an individual account, opened in 95, 48 months, date of last activity in 98, high credit was $1,100, I guess it was not a big automobile, terms $500, balance of $200, okay, and you can see that all the details on those accounts. Now this section, inquiries. One of the things you want to be careful about is when you are in the process of pursuing a mortgage, don't go shopping for every kind of credit in the world. In fact, once you officially begin working this process, you really don't want to have your credit pulled by potential creditors, because in evaluating the risk, if I'm looking at your financial situation and I see where you've applied to credit for 8 different agencies, then you may be creating some risk out there that I'm not aware of, and you're going to have to explain to me why you're out there shopping around for a credit card and some furniture accounts. So if you're applying for a mortgage and you're already out there seeking additional debt on top of it, then we need to understand what kind of risk you are actually going to be. So once you start the process, do not apply for anything. Okay, don't even apply for a pencil. Okay, just be aware. Moving down the credit report, you'll see that the accounts are rated. Okay, you'll see that they are rated by R1, I1. They're rated 1 to 9. R for revolving, I for installment. 1 is the best you can have. This I5, that means it's a collection account. And I2 or R2 or any 2 means it's 30 days behind. 3 means it's 60 days behind. 4 means, you know, it's gone. And it's by then it's written off to collections. And so you've got some collections activity showing up in the collection section up above. And so you really want to look and make sure you've got all 1s on your ratings. If you've got issues on your credit report that are incorrect, it's the obligation of the credit bureau to correct that incorrect information. And now the Fair Credit Reporting Act, the law that governs it, gives them 30 days to respond once you notify them online or in writing. They're notorious for not getting things done on time, but stay on top of it and get it cleaned up and make sure that the information is correct. Sometimes you will find information that is correct, and a lot of times people will dispute it, and if the creditor cannot substantiate it, the law says it has to come off. Some of the things you'll see with credit scam artists: beware of credit cleanup people. If you've got less than perfect credit, the only thing that can really clean up your credit is a change in behavior. Now, so again, back to American greed. If it sounds too good to be true, okay. I can't tell you how many people I've talked to who paid somebody $500 and they're supposed to get this stuff off of my credit report, and they come in and they apply and it's back on their credit report and they're fuming. Well, what happens is that people file disputes and they're temporarily put in a dispute status, so they're pulled out temporarily, and you look at the credit report and, oh, they've cleaned me up. But when they contact that creditor, the creditor says, no, this is legit and here's the documentation, they owe me the money, and it comes right back. So the money you spent on the cleanup person would have been better done on those bills. Now let me give you a few pointers for how to get some of these things done. You may have a I-5 or an R3 or whatever. Here's what you do. Contact the creditor and and figure out before you contact them in your budget what can you pay reliably and pay it. Contact the creditor, make a new arrangement, and pay it. And ask that then they begin to report that you're paying a new agreement as agreed. So you turn that I-5 to an I-1. Okay? And then when somebody like me looks at it and says, wow, they had some issues, but now that same account that had those late payments is now a 1. So there's a turnaround happening there. And so when you begin to convert those credit issues so that your report says what it should, then you won't have those exorbitant payments that we saw before. Okay? Now, moving right along down this same credit report, you'll see an explanation in case you don't remember everything of what all the codes mean. Okay? The type of accounts, the status, and the inquiries. So you'll be able to update. Now let's look at some commonly asked questions on credit files. Why did you turn down my request for credit? Well, you know the answers to that. The credit bureau doesn't make any decision. Whomever is issuing you credit makes a decision based on your history. Do credit reporting companies, the credit bureau doesn't rate your account. The people you owe rate your account. Can I correct the mistake? Yes, we talked about how you do that. What is it in my credit file that keeps me from attaining credit? Well, it's the entire history. If you're not getting the things you want, you have to take a look at what your history has been, what your payment history has been. Do you have outstanding balances that you owe people that haven't been paid? Now, the things that will pull your credit score down the fastest is the presence of collections accounts. Let me go back up to that. The thing that will destroy, even artificially, because you can have a reasonable credit profile otherwise, and that Sprint bill that you didn't pay for $100 is dragging your score down artificially, probably by 75 to 100 points. So there may be some little collections items or some little things out there that you need to get rid of because they're artificially dragging it down. Okay, and it's just a hurdle keeping you from getting to where you want to go. So get rid of those and have on-time payments, and you'll see your credit score rise, because it's not a static number. It changes over time. It's rescored periodically based on the new information, because we know that people with certain scores, and we'll look at this a little more in a little bit, that the fact that you've got a 620 and no late payments doesn't mean you're not at risk. Because if I look at your balance and says that you got a lot of payments that you're juggling and nothing has hit the ground yet, but if I see growing balances on credit cards, growing new credit, lots of balances growing, then we know you're headed for trouble, and it's just a matter of time. So we take a look at those things as well. Your employment, your credit score, okay, and all of those things go together to determine what your risk is. And again, all of this sounds semi-complicated, but it's really simple. Do you look like you're going to pay me back, or do you not? If you don't look like you're going to pay me back, just like if it was your money, it won't be loaned to you. Now, I'm going to switch gears from wrapping up on what the credit report looks like and how it impacts what you pay. I want to reinforce that if you have poor credit, you pay more for everything, okay? Now, debt ratios. Here's a concept. How much can I be approved for? That's the question you really want to know. We've talked about how much you can afford and you've already gone through the process of figuring out what you're going to budget for house payment. Now, let's talk about how you get approved. There are two ratios. You've probably heard of debt ratios, and you heard somebody say that they got turned down for something because the debt ratio was out of whack, and they had no idea what the debt ratio is. It is a formula that basically tells me how much of your paycheck is already consumed. Okay? There's a front-end ratio or a housing ratio, and then there's a back-end ratio or total debt ratio. That housing ratio, that PITIM, which we'll go through in the book, principal, interest, taxes and insurance, and mortgage insurance, your total house payment divided by your gross monthly income. Now, traditionally, that needed to be 28% or so, and the first time I saw this when I was a young aspiring homeowner, and I said, who in the world can add up all, yeah. That's the target ratio to be approved for a traditional mortgage. Back-end ratio, that's all your debts. That's your PITIM for your mortgage, your car payment, your student loans, all of your payments that show on your credit report, add them up, divided by your monthly income. Traditionally, they need to be 36%. For an FHA mortgage, they need to be 41% or less. For a subprime mortgage, which you do not want, you can get approved for higher. You'll need it given those types of rates and payments we saw. So, what I was getting ready to say earlier was, I looked at this for the first time and said, who in the world adds up all their bills and it's only 36% of their income? No one. Well, That's your gross income. The rest of that 64% is the third of it that you pay for taxes, insurance, and daycare, and every other thing in life that's not on your credit report. So those fixed monthly obligations need to fit within those ratios. Again, for a conventional mortgage, 36%. For an FHA mortgage, 41%. So that, translate that back, when I add up everything that you've got to pay on a monthly basis, it's got to fit within those ratios for you to be approved for the type of loan. That's what pre-qualification is, folks. So you can pre-qualify yourself, and if you really want to trip out a loan officer or a lender, show up and tell them, I've taken a look at my ratios, and I know what my budget says I can handle, and my back-end ratio is this, and my targeted payment is this, and therefore this is the amount of house I'm shopping for, and this is the amount of loan that I'm shopping for. And we've talked about resisting the temptation to allow somebody to sell you more than is budgeted just because you can get approved for it. We're not targeting what you can get approved for. We are targeting what your budget allows you to afford. All right? So, continuing along, you now know how to pre-qualify yourself without anyone having to do it for you. Now let's take a look at debt ratios illustrated. And we've got two people here, okay? A and B. Now the first person, okay, they've got monthly income of $2,000. Second person got monthly income of $2,000. One person's got some bills, got a car payment, credit cards, furniture, $400 worth of obligations already committed. Second person has none of those payments. So with an FHA mortgage, maximum debt ratio 41%. So their debts, including their house, need to fit within that $820. So for person A, since $400 is already taken, they've got $420 to use for house payment. The other person has $820. It's obvious who can shop for more house. The person A is limited by their prior obligations. Okay? Cut and dry. That's the way debt ratios impact you. So don't go out and buy your BMW and all of these obligations before you buy your house, okay? Because they will come back to haunt you as they did person A in this example. So if we look at, remember 420 and 820? Okay, and as we look at, so the one person can afford about $70,000 worth of house, and the other person actually can be approved for quite a bit more. So that is the illustration of the impact of debt ratios and how many obligations you have. Again, the person who has 420 left in their debt ratio has to come in around 70. The person who can use the entire 820 can go higher than this number. Now, is it a good decision for their budget? Only their budget knows. And that's why you have to start there to protect yourself from getting into a situation where you will be in trouble. And we've seen it lots and lots of times. So you can now qualify yourself and do your own debt ratios, and you are armed then to talk to lenders, and they don't have to pull your credit report. Okay, you can say, this is my credit score, this is my debt ratio, this is what I can afford, give me your numbers. Okay, so how much of your budget say you can afford? That's the question. All right, so now that we've walked through the impact of credit and debt ratios, let's then go back to where we were at. So we've talked about the lenders, we talked about the types of mortgages. Now let's go back and talk about fixed rates versus adjustable rates. You've all heard these terms before. fixed rate versus adjustable rate. And fixed rate is just what it says. It says that your interest rate and your principal and interest payment will remain fixed for the entire life of the loan. Okay? Your taxes may change. Your insurance may change. Now let's talk about how you pay your taxes and insurance. There's in the glossary, escrow account. An escrow account is a holding account. For FHA mortgages and VA mortgages, you are required to escrow and I highly recommend for new home buyers to escrow their taxes and insurance. What does that mean? That means that I pay my taxes and insurance every month with my payment. I don't get an annual bill once a year for $600, $800, or $1,000 for insurance, and I don't get an annual bill for a couple $1,000s for taxes. I pay 1/12 of both of those with my monthly payments. That's why the PITIM, your total payment, principal, interest, taxes, and insurance and mortgage insurance, so that then that money accumulates in an escrow account and it's on your monthly statement. And when the taxes are due in November, the mortgage company will pay the taxes on time with a 4% discount for paying early, and which they are required to do, and you'll get a statement saying they are paid. This is not a bill. Same thing with your insurance. On your annual date when it's due, pay the money out of the escrow account, and those insurance policies will be enforced. And you don't have to worry about coming up with it at some anniversary date. I highly recommend that first-time home buyers have the insurance and taxes escrowed, which means they pay 1/12 of them with the payment, and you don't have to worry about it. Now, adjustable rate mortgages. This is for information only. I strongly submit that no one within the sound of my voice should be looking for an adjustable rate mortgage for several reasons. And I'll explain how adjustable rate mortgages came along. Because they really came about in the early 80s when we had hyperinflation. Interest rates on mortgages were 14 and 16%. That's for people with good credit. That right-hand column, that was for good credit. If you could get it, mortgages were. So it was a kind of an out-of-control situation. And so as people were getting approved for mortgages, the financial industry had an innovation of an adjustable rate mortgage that says that if you enter this mortgage, then we'll readjust periodically, annually, every 2 years, every 3 years. And as rates go down, your mortgage payment would come down and adjust down with it. Made a lot of sense when rates were 14, 16% because they had to go down. And then people did not have to incur the fees of when you refinance to get a new loan to replace that high interest rate mortgage with a low interest rate mortgage. You were going to spend about 5-6% in fees, which eats into your equity. So the adjustable rate or mortgage was a beautiful thing. Your payment comes down as interest rates come down, and it made a lot of sense. Now, since then, the rules have changed, and we went through a period where rates came down and they were extremely low, and the mortgage took off again. But what the mortgage industry did was they changed the game, okay? Most of adjustable rate mortgage contracts now that have been written in the last 10 years don't go down anymore. They only go up. They only provide a facility for going up, which is one of the reasons why you want to stay away from it. In addition to the fact that rates are as low as they've been in my lifetime and in a generation, which means they can only go up. So there's no reason to get into a rate that can go up. So there's no reason for you to be looking at an adjustable rate mortgage. I'll explain how they work. You've got an index, and they're usually pegged to either the prime rate or LIBOR, London Interbank offer rate, and you've got a margin. Your mortgage contract will stay with a margin. So there'll be a margin of 4%, 5% over that index, so that if you wake up tomorrow morning, if you entered into a mortgage for 4% and rates go up, and on that date they review it and the index has gone up, then going up by 2%, then basically your mortgage is going to go up by 2%. That's just the way it is. And so just be aware, and also be aware that the contracts that are written today don't go down, they only go up, which is kind of a raw deal, which is why I recommend that you not even be considering them. Convertible mortgages, again, some ARMs flexible mortgages are convertible to fix. Again, all these issues of temporary buy downs or gimmicks in pricing, you stick with straightforward fixed rate. Here's my rate, here's my down payment. Okay, temporary buy downs is something that we've used for when people's ratios were really close. They could pay a little more upfront to buy the rate down by 1/4% to make their ratios work. But you're teetering really close to the edge of the ratios at that point. Again, this is for information only. Fixed rate mortgage, the best fixed rate mortgage you can get. Straightforward, no complicated language, no gobbledygook, and you'll be fine. Otherwise, you're at risk of being hoodwinked, bamboozled, run amok, led astray. Now, a very interesting type of mortgage offered by FHA is the 203K, which I'll call the fixer-upper loan. What this allows you to do, for those, it's not for the faint of heart. I really don't necessarily recommend a first-time home buyer get into a major project, but to buy a house that's ready, that's livable, enjoyable, right set of terms, and move in and leave. These types of issues for those who are more daredevils. But you can create equity by buying a distressed property and then hiring a contractor to fix it up, and when you're done you will probably have some equity position in that property. The 203K requires a licensed contractor, can't be your Uncle Bubba doing the work. You enter the contract for the house, you get a written commitment from the builder for the cost to build, and then you close the loan with the money included for the purchase and for the rehabilitation of the property. And that money is held in escrow and released to the builder, the contractor, as the improvements happen, and then you do your final closing and move into your house. Most folks doing FHA mortgages don't do 203Ks, but you can find someone who will. Again, most of you, I don't recommend pursuing this path. Get a straightforward mortgage with a straightforward house that's ready for you to move into, and no fixing up to be done for quite some time. Okay? Now, comparison shopping for loans. How do you compare one to another? That's always been a difficulty. It's always been difficult to compare one lender to another. When you go to the paper on Sunday and you look at lenders, you'll see it's not an apples to apples when you look at the chart. Some will have a discount point. What's a point? A point is a fee. A point is 1% of the loan. Okay, so if I got a $100,000 loan and they charge me one discount point, that means I got to pay a $1,000 fee to get the loan. If it's 2 discount points, I got to pay 2. Okay, but that is a fee for getting the loan. Okay, so your down payment goes directly to your equity. Okay, so if I'm buying a $100,000 house, okay, and I put $5,000 down payment, that down payment reduces the amount that I have to borrow, and so now I only have to borrow the other 95%. Now, the discount points or any other fees are in addition to your down payment. So when you're figuring how much money you're going to have to bring, you're going to have to bring your money for your down payment, and you're going to have to bring the money for your fees, and we're going to look at that when we look at the good faith estimate and some of those, and we'll look at that in very great detail when we look at the closing section. Okay, so you're going to have to figure out how much money you're going to have to bring, and it includes your down payment as well as any fees that include the points. Okay, and there are other fees that you'll see that are included in the closing costs, and we looked at some of those when we looked at the contract. And Your annual percentage rate, that's one of the things that you'll see on the charts when you look at the paper at lenders. Your APR is not your interest rate on your loan. When you look at your good faith estimate and your truth in lending, which we'll look at in a little bit, your APR is something that the government came up with because it's so difficult to compare apples to apples, because someone will charge a fee with 1 point, someone will charge a different rate with less points. And so how do you, or what the APR does is it takes all the fees associated with the loan and treats them if they were prepaid interest and say, what would the interest rate be if all those fees were loans? So in theory, the APR allows you to do an apples to apples comparison of loans. Now, here's one thing. If you look at your interest rate and you look at your APR and they're very different, that means you're being loaded down with a lot of fees. If your APR is about the same as your interest rate, that means you have low fees. Okay, keep that in mind when you look, and we'll look at it on the truth in lending. If you have APR, if your interest rate is 3% and your APR says 4.5%, that means you got a lot of fees loaded into your loan up front. That's one of those things that you just need to understand. Informed consumer choice. That just says that FHA requires a tougher inspection of the property to protect the consumer, and we generally think of that as a good thing. All right, now it's time for quiz number 1. Let's go ahead and get the quiz out, and we'll go through it. And
SAT, stump the chump type exercise, but we're going to reinforce and make sure you have an opportunity to take advantage of all the learnings and know where it is. Number 1, explain the difference between primary market and secondary market. The answer is found on page 51. The primary market is a retail market, or where you go in to apply for a mortgage, or the customer-facing part of the industry, and the secondary market are those where those loans are sold off to, either to investors or and we talked about that in detail. Second question, what is PMI? Private mortgage insurance, answer found on page 53. The insurance you get to pay to protect the lender, to protect against the risk of default, since you're putting down less than the traditional 20%. Next question, what do the acronyms FHA and VA stand for? Federal Housing Administration and Department of Veterans Affairs on page 53 and 54, and we talked a lot about what those benefits and what they do. Next question, what are the 2 types of mortgages? Of course, page 55 and 56, they're talking about the fixed rate and the adjustable rate mortgages. We explained how the adjustable rate mortgages are structured, but we also reinforced the fact that you as a first-time home buyer almost always is looking for a fixed rate mortgage, especially at this point in the interest rate cycle. Next question, what is a 203K loan? That is a rehab loan, a fixer-upper loan, where you can borrow the money to acquire the house and for the improvements to the house to bring it up to where it needs to be. And we talked about a lot of that in details and the requirement as well on page 58. Last question, identify 3 factors that a prospective home buyer should consider when shopping for a home loan. And those are on pages 58 and 59. Things like the interest rates, things like the down payment, and all the other factors. You want to go back through those carefully. And of course, we talked about those in excruciating detail as well. So that's the first section on shopping for your lender. Next, we're going to talk about getting into the actual loan application and your credit and those issues. So stick around, and I'll see you back here at the time of the Section 2 quiz. Have fun.
Okay, we're back. Shopping for your loan. And we actually covered a little bit of this section in the last section, so it should go a little bit quicker. Mortgage loan process, the wait. And it does seem like a wait sometimes. Some lenders get things done faster than others, but it can seem like but one thing I'll tell you, the more complete your information, the better the likelihood of things going quickly. I've seen cases where the entire process took place in a week because everything's in place, everyone was prepared. Typically, if it drags on, that's probably a sign that things are missing, information is floating in, there is extra risk, there's issues with the property, there's issues with the borrower. If everything is as it should be, it can be a very smooth process. So you'll need to get started. The sales contract, you bought the house, we got pay stubs to substantiate our income, W-2s and tax returns probably, information on the long-term debts, and toward the back of this section will give you a detailed list of documents that you want to have prepared and be bringing along with you. Your bank statements, tax returns, proof of other income, information on the property, and the real estate listing. All things that make sense and that are necessary for the information for the loan. Now, good faith estimate, this good faith estimate is actually dated. They came along and changed the look of it, but there's certain information that a good faith estimate should give you. The realtor will give you a good faith estimate and the lender will give you a good faith estimate, but what that does is put down in writing what your fees are and what the payments and expectations are and how much money you should bring to closing. The other thing about the good faith estimate is it allows you to then be able to comparison shop, zoom in on the individual numbers, that what fees are every fee that's being charged should be included in the good faith estimate, and there's a legal requirement that it be provided within 3 days of your loan application. Most of the time the person will give it to you right there, so that requirement is taken care of. Real Estate Settlement Procedures Act, law governing real estate closings and activity. Closing costs. You've probably heard this term and wonder exactly what that is. Those are the costs associated with executing the transaction. And let's take a look at what some of those costs are. The closing agent or attorneys, that escrow agent, typically that's paid for by the seller, but everything is negotiable. All closing costs 100% could be paid by the seller depending on your mortgage. We talked about the fact that FHA and VA mortgages allow you to have the seller pay all the closing costs up to 6%. So you could walk into a mortgage where you're just coming in with your down payment and the attorney fees, property taxes. When you buy a property, whomever sells you that property is liable for the taxes up to that date. So if I buy a property on July 1, then when we close, the person who sold it to me has to give me the money for that half of the year taxes that they occupied the property, because in November when that bill goes out, it's going to go out for 100%. They don't care how many days I own it. I'm the owner at the time of the taxes. I owe 100% of that year's taxes. The person I bought it from should have paid me that daily rate up to the day of closing. Okay? Interest paid to the day. Again, when you buy a mortgage, when rent is payable in advance, so that on January 1st you pay for the use of the property for the month of January. Mortgages are actually paid in arrears, so the interest accrues in January to be paid on January 1st. So if I buy a house in the middle of the month, then my next payment won't be due until the beginning of the next month. So for that 2 weeks, I go ahead and prepay the interest. So that's a part of the money you bring to closing. loan origination fee, whether the point or whatever they're charging you to give you the loan, that's a fee which you have to pay. Recording fees, which is paid to the county and the state to record the mortgage, record the deed, record the note. Well, the note usually isn't recorded. The survey fee required by the loan. It's a matter of negotiation in your contract who pays all of these. First premium of mortgage insurance if applicable, and title insurance. The seller of the property will, in their case getting a mortgage, deliver clear title. What does clear title mean? When you purchase a property, the title insurance, and I read an article that said Abraham Lincoln's family lost their farm because someone showed up with a prior claim that says it's theirs and they lost it. What the title company does, and the reason we buy title insurance, is that they issue us a guarantee that this property is free and clear of any encumbrances. Nobody owes anything on it. And if there is some prior issue from a prior owner, the title company is saying that's our issue and we're going to pay for it if it shows up because we've done our due diligence. They go back and search for 30 years in the public records. They'll search all prior deeds, all prior sales, all prior everything to make sure everything is properly exchanged and conveyed so that you are acquiring a property that has no legal issues. And if there is a legal issue, that title insurance policy says that the title insurance company is on the hook for whatever that is because they assured you, you bought the policy, they own that risk of any legal issues with the property. And believe me, that loan will not close until all issues are addressed because there is financial risk associated with it. So you will get a title insurance policy. No lender will lend on a house without insured title saying that I'm not lending money on a property that has issues and claims against it of all types, be it taxes, be it prior owners, be it improperly prepared documents, whatever it is. If it's an issue, then it's going to be cleared up before the title company will issue a clear title policy. Prepaids, we talked about those, things that you pay in advance. You may pay in cash for the credit report fee. You may probably have to write a check to the appraiser when he shows up to look at the property. Those things have been already paid outside of closing. Prepaids are things that they bill you to at closing that you haven't written a check for. Paid outside of closing means you already paid for it, so that's credited and you're not being charged for it at closing. Okay? Your truth in lending statement. We talked about this. This is a statement that shows you, this is really your shocker, because when you look at your truth in lending statement, it's going to show your annual percentage rate, which we talked about, which is not your interest rate on your loan. Your interest rate on your loan will be stated on the form, but it will not be your APR. Your APR, again, takes all of the fees that you're paying and treats them as if they're prepaid interest. And again, if your APR, annual percentage rate, is significantly higher than your interest rate, then that means you have quite a few fees being built in there, whether they've been brought to your attention or not. Your finance charge is going to show you your total finance charges over the life of the loan. Just be aware that if you've got a $100,000 loan, your total finance charges for a $30,000 mortgage is going to be another $130,000, so that over the life of the loan, you're going to pay $230,000 in total payments, and we're going to look at some of that when we look at the amortization schedule. And so as a matter of fact, why don't we look at that amortization schedule right now and illustrate that a bit for you, okay? All right. Amortization schedule. Here is an amortization of a $100,000 loan over 15 years, and we'll look at 30 years as well. It's got 6%, higher than today's rates, for 15 years, principal and interest payment of $844. Okay, Now, at the end, in the first 12 months, your balance has gone from 100 to 95. You have your interest and principal breakdown on that $844. You can see that you are paying more interest than principal. In that first year, you pay $58.85 in interest and $42.42 in principal. Now, if you go down, as your balance drops, then more of your money is going toward principal. And if you go down here in the 14th year, you've got majority of your money going to principal, and the interest for the life of the loan has been $51,000. Principal paid $90,000. So you paid about $152,000 for that $100,000 house, right? Now let's take a look at the 30-year amortization, okay? Now on the 30-year amortization, it looks a little bit different. Let's make that a little bigger. So that now each year, first of all, your balance is dropping a lot slower. In the first year, you got $600 in payment, so you paid $7,200, and only $1,200 of it was principal. Okay, and then when you go down here to the 10th year, same monthly payment, but different breakdown of principal to interest. If you go down to the 20th year, it's a different breakdown of principal to interest. And then when we look at the entire life of the loan, then we can see as we get down to the latter years, then you've got a lower balance. That $600 payment is overwhelmingly principal, but over the life of the loan, you have paid $225,000. Over a 15-year mortgage, you pay about 50% of interest. Shorter amortization, the longer you spread out a loan, the greater the amount of total interest you pay. That's the way amortization works. That's the way the loan pay down works. And so you can see, now, one of the things that I'll advise you to do is that you can take a look at, go to bankrate.com. Bankrate.com, you can print an amortization schedule like this, okay? In addition to that, you can take a look at what happens if I pay an additional $1,000 at the end of the year when I get my tax return. I can tell you that if you pay the equivalent of one extra payment a year, if you pay the equivalent of one extra payment a year, a 13th payment a year, you cut 7 years off of that mortgage. That's right, 7 years. One extra payment a year takes it down to 23 years. Cuts a lot of that interest off. Now, when you go to bankrate.com, you can go into an amortization, and it will allow you to say, what if I pay an extra $100 a month? What does this pay down look like? What if I paid an extra $100 a month and an extra payment a year? What does that payment look like? And you can set your plan for how you can pay it down faster, accrue your equity faster, and pay less interest over the life of the loan. Bankrate.com, a very good resource for you, and you can play with those scenarios till the cows come home. You can print them out, you can study them, and you can make your plans for how you will pay your balance down, amortize your loan over time. All right? So now let's go back to where we were. And so you can now see why the total payments that you will see on your Truth in Lending will show a shocking number. If it's a 30-year loan, $100,000, we just saw how much you pay, more than twice that. So don't be alarmed. And we just talked about the ways that you can manage that number. Now, if you got a variable interest rate, which we talked about you not wanting, it'll explain those features and the way they pay down. For a fixed loan, it'll have 360, the amount of payments, and when they're due and when it's paid off. Period. Straightforward. That's all you want to see. I do not wish to see any of you in a variable adjustable mortgage at this point. Property insurance, address that you have to get it and you'll pay in the term. It's not determined by your lender. You get your property insurance from whomever. You call up an agent, they'll give you a quote, they'll write you a policy, and they'll send it to closing. The loan will not close without the property being insured, and the mortgage itself will say that you are required to maintain insurance and several other things that are required. You're required to maintain it in good condition. You're required to pay the taxes. You're required to not have hazardous materials. All of that is in that 6 to 12 pages of document that is your mortgage. Okay, it'll also on your truth in lending spell out specifically late payments, how much a late payment, if there is a prepayment penalty. What is a prepayment penalty? Prepayment penalty means I'll charge you some extra money for giving me my money back early. Good mortgages don't have a prepayment penalty. Subprime, high rate mortgages that we looked at in a prior chart will have a prepayment penalty. If you work and take the time to get your credit to the condition where it needs to be, you will not have a prepayment penalty. If you look at your truth in lending and there is a prepayment penalty, that's a surefire sign that you don't have a Fannie Mae, Freddie Mac, VA, or FHA mortgage. You are about to get hoodwinked and taken advantage of. There should not be a prepayment penalty in your mortgage. Assumptions, no mortgages today are assumable. 30, 40 years ago, FHA and VA mortgages were readily assumable. You can pay a $500 fee to the agency. They transfer that mortgage over to you. So mortgages are no longer assumable, so you don't have to spend a whole lot of time thinking about that at this point. Okay, moving right along. Next page, property appraisal. We talked about that in the last section. The loan is based on the sale price. The sales price cannot be more than the house is worth. So if the house is worth 90, I can't agree to pay $100 and get a loan based on $100,000 and the house is only worth 90. If your house is appraised, you're in a contract for 100 and your house is appraised for 90, then you've got an option. You can go back and renegotiate, or you can walk away, but you can spell it out in the contract. But the deal will not go forward for a price that's higher than your appraisal. Again, definition from the last section when we did the real estate. The property appraisal is a financial instrument that determines or establishes what the value of that property is. Now let's explain again how the appraisal is done. It's some art, some science. Okay, the appraisal compares your property to like properties recently sold. There will have to be a property that sold less than the last year, and it needs to be in the neighborhood. You can't go across the highway to another neighborhood and compare your house to a house in a dissimilar neighborhood. The best comparable, and in the appraisal, they'll do a comparison of 3 to 6, what they call comps or comparable sales. And the best comparable sale is an exact same house that sold yesterday. That's usually not available unless you're a builder and you sold one yesterday and you're selling another one today. So as you move away from that, the appraiser will make adjustments for the time, for the distance, for the difference in size. If another house sold in the neighborhood 3 months ago and it's 200 square feet difference, he'll make a calculation for the value of those square footage to adjust. If there's a difference in whether or not there's a pool, they'll adjust so that they were comparing apples to apples, and they'll adjust a dollar amount for each one of those attributes. At the bottom of the page, he'll come to a range, and your house will fall somewhere in that range. If he or she is conservative and it's a period where house values are not increasing, you will be on the lower end of the range, a very conservative number. Sometimes when the market is robust, you can be on the higher end of that range. Also, depending on how your property compares to the other properties in that range. So it's some art, some science. Regardless, the underwriter who's approving your loan has the last say. She can bust the appraiser's number down to what he or she thinks is the reasonable risk associated with that property. Okay, so appraisal is an important document, can be challenged. You can bring another appraiser where there is a disagreement. You can go get another licensed appraisal and send it in. They may do something in between. But again, the underwriter who is approving, who's an underwriter? The underwriter is the person who, once your loan application goes in, they sit down and take a look at, they assess the risk and approve or not approve the loan based on the risk that they see and the information that's there. Homebuyer Protection Initiative, we talked about the fact that FHA requires a more stringent inspection of the property to protect you, the homeowner, from being stuck with something that is less than you think you're buying. Now, here's a section that we want to actually spend a little bit of time on. Predatory lenders. What are predatory lenders? It's just what it sounds like. People who take advantage of folks who haven't been to a home buyer course. The real targets for predatory lenders: equity-rich properties, gouging senior citizens, got a lot of equity in their property, and they refinance them and skim equity, and lots of scams in there. Cash poor family or individual, you don't have the money for the down payment, so you get hooked up into some crazy deal that really takes advantage of you, give you a deal that's over on the other end of the spectrum that we looked at, and you really want to take your time. That usually happens when people who are in a hurry, not taking their time to get prepared. Okay, no credit history, poor credit. Again, we talked about the fact that just about anybody can get a house, but you don't want to pay that price. You don't want to pay those high fees. You don't want to pay those high interest rates. You want to take your time and work your way into a quality mortgage product. The more you're in a hurry, the more you want to make an exception for not having paid your bills. You want to make an exception for not having a down payment. You want to make an exception for not having stable income. Every exception pushes you more to that expensive, less attractive category. Elderly, target for lots of scams, and minorities. It's just a fact that in this country, minorities, and we're not just talking about history, we're talking about in the prior decade, it's just a matter of fact that minorities did not get the best mortgages. Minorities got more high-rate mortgages with the same credit, with the same income. The studies have shown that minorities were sold higher fees, higher rate mortgages at the same time with the same credit. So just be aware that you need to shop, and do not be afraid to say, I'm going to compare to somebody else. Do not be afraid to ask for better. Ask for it or you won't get it. Okay, and do your homework to know what the comparison shopping. Again, back to sites like bankrate.com. They do a very good job of comparing. You can take a look at what national averages are. You can take a look at who's offering what. So that's a resource that you very much want to take advantage of, along with the others that I've shared with you. And so be aware that you don't want to fall prey. But if you're doing all the things that we talked about, and you're going after the types of mortgages that we talked about, if you're getting a Fannie Mae mortgage, you're not worried about these issues. VA mortgage, you're not worried about these issues. FHA mortgage, you're not worried about these issues, okay? So caveat emptor, let the buyer beware. Further warning signs, and you know in your gut when you're being worked. Back to the American greed. When we want what our budget says we can't afford is when we get in a position to get taken advantage of. When we don't want to take the time to clean up our credit and get prepared, we put ourselves in a position to be taken advantage of. When you get too anxious, you're almost always in a position to get taken advantage of. Okay? Now, in almost any type of consumer activity, when people are aggressive, be careful. We talked about this with the in the last section. The appraiser, lender, you want to be really careful, and I don't want to say disparaging remarks about realtors, but it just happens that just like myself in transactions, I'm there to get paid. The realtor is there to get paid. And be careful about having all your resources provided by or referred by the same party who has an interest in the transaction. Because on that $100,000 transaction, there's $6,000 of realtor money there. And by the time you're at this point, everybody spent a lot of time with you. Everybody's shown you a lot of houses. The lender has spent a lot of time with you. And you've got the appraisal and you've got the inspection in between you and closing, and those really protect your interest. So you want to, now the lender who's lending the money now provides the appraisal. In the past, you could go find an appraisal whoever you want. A little bit of funny business was happening in the market, so they controlled that by the underwriter of the risk assigning the appraiser. The home inspector, go ahead and start shopping for home inspectors now. We talked about in the last section the kinds of things you want with a home inspector. You want them to have a contracting construction background so they understand the underlying systems. You want to know that they're going to email you a copy of the inspection report complete with pictures and recommendations of repairs. We talked about the fact that it'll be very, very useful in negotiating prices and everything. If everybody's in a rush to get to closing, be careful. If you get to closing and anything is different, you've got the right to get up and walk away. Hear ye, hear ye, hear ye. What happens to many folks is, okay, you're approved. You're going to get to closing. Okay, now you've gone and you've discontinued your lease. You've given your landlord a piece of their mind, chewed them out, cussed them out, and told them where to go, and you're going to be out of here. And you get to close, and you got your stuff in the truck. And I've seen this, okay? I've seen this. Do not pack the truck before closing. Don't get the cart ahead of the horse. You're going to get yourself in a situation where you're stuck at closing. Don't pack the truck. Don't cuss out the landlord. You don't own a house until after closing. I've seen issues where people got everything on the truck. They get to closing, and the numbers are different. The rate's different, the payment's different, everything's different, and they're at closing, and they got the truck backed up in the driveway. Everybody's ready to unload the truck, and the terms are not right. What's going to happen? I can tell you what's going to happen. They're stuck. They're going to sit there, and they're going to grumble, and then they're going to pick up the pen, and they're going to sign where they should not have signed because they put themselves in the position where they were stuck. Can't go back to the old place. You already cussed out the landlord. You got your stuff on the truck, and he's rented it out to somebody else. That's already under lease. You get to closing in that situation, and you're stuck. You're going to sign it, whether it's disadvantageous or not. Do not get the cart ahead of the horse. Don't pack a truck until you got the keys, okay? Can't overemphasize that enough. Interest rates change. Adjustable rates, we talked about staying away from that. Balloon payments. Balloon payments is you got a 30-year mortgage, but at the end of the 15th year, you got to pay it off and either refinance or get something. It's amortized, so your payments are based on 13 years, but you don't have 13 years. Your payments are based on 30 years, but you don't have 30 years to pay for it. You got a balloon at 5 years where you got to go do something, or a balloon. Very dangerous concept. The Fannie Mae, Freddie Mac, FHA, VA mortgages, you don't have to worry about any of that nonsense. Excessive fees, points, late charges, again, those programs limit what fees can be charged. So as long as you're pursuing the better quality product, you don't have to worry about that. Unnecessary debt consolidation, all of these happen when you're playing in the wrong column, pursuing the wrong type of product because you haven't taken the time to clean up and get prepared. Refinancing unsecured debt, you don't want to be rolling your credit cards because what all that does is you're going to zero out and you're going to run them back up. Now you've eaten up your home equity because you consumed it with credit card, which increases your payment, and now you run up a bunch of credit cards. So be careful. You want to really protect your home equity by not refinancing and using it as a piggy bank to pay exorbitant lifestyle bills for vacations and concerts and a bunch of other junk that you won't even remember what it was. Open-end credit for home improvement, multiple refinancing. For now, you're first-time home buyers. You're not dealing with any of these issues. Keep it simple. Keep it straightforward. Stay in Fannie Mae, Freddie Mac, FHA, VA column, and you will be fine. All right? Enough on those risks. Loan processing. Now that you've applied, now that you've submitted and you're waiting for final approval. You've had the pre-approvals, you've done your loan application, and now we're waiting for final approval. There's going to be some verifications, okay? An underwriting risk, what an underwriter does, underwrites the risk, assess the risk of this transaction so it can be approved or not approved. VOE, verifications of employment, it's a form you will sign telling your employer that you give them permission to give the lending company information about your employment, your income, your length of income, the likelihood of continued income. That will be verified in writing before we lend you money. Verification of deposits, okay? A verification of deposit. Now here's where you want to listen up, okay? A lot of people get stuck with this one. You are going to, as we discussed earlier, have to have a certain amount of money to complete the transaction. And in many cases, you will also be required to have reserves to minimize the risk. Now, that also includes all of your cash resources, your savings, your 401ks, all of those things that provide a cushion against risk. But the monies that's required for closing and the money that's required for reserves have to be what we call sourced and seasoned, okay? You know where it came from, and it didn't just drop into your account mysteriously yesterday, okay? Now, if you got an established account and it's been around for more than 6 months, then you're in good shape. New deposits, you want to explain. Now, many programs, FHA and some family programs, allow for gifts for the down payment from a family member. There's a gift form to verify and certify that they're providing you a gift that is not intended to be paid back. It's not a loan. No one is going to approve you for a loan where you borrowed the money for the down payment. But you can get a gift from a parent, a relative, from an employer, or from a nonprofit in some cases, or from a housing agency like we talked about, state administered funds in Florida, the SHIP funds, down payment assistance, $5,000, $10,000, $15,000 of down payment assistance in some cases. That's all verifiable. What happens is where somebody's going into closing and 30 days ago you got some mysterious money show up, we're going to have to know where that came from. We're going to, and they will probably go back the whole trail back to verify who provided it, where it came from, why it's showing up now. And you ask yourself, if you didn't have the money at the start of the process, why are you in this process in the first place? Well, the process can be long. We can be getting ourselves to there, but understand that you want to carefully document where your deposits come from, and the underwriting process will require that. So you want to go ahead and start having your deposits in place in advance, and you really don't have to deal with that sourcing and seasoning issue. How much can we afford? We have talked about that one ad nauseum. Monthly income. Now, monthly income for some folks who have not been in this process before, your monthly income is not your weekly times 4. It is your annual divided by 12, which will be a different number because there are 13 4-week periods in a year to make 52 years. So your annual will be more than 4 times your monthly. And we calculate it based on the number of hours. If you're working 30 hours a week, we'll take that hourly times 30 times 52 divided by 12. If you're working 50, when you can substantiate that you consistently, and that's where that VOE verification of employment comes in. If you claim that you're working 50 hours, it's going to say that you typically work 50 hours, and we can use that income. So that's the income will be verified as a part of the process. loan limits and terms. Again, we've talked about that quite a bit. The loans actually can be approved with a 15, 20, or 30-year period. The reason that most loans have 30-year periods is because, as we looked at the difference in payment between the 15 and the 30-year on the when we looked at the amortization schedule, most folks' cash flow for what they want to buy will not fit in a 15-year loan to be approved. Now, what you can do as a strategy, and I advise many people to do this, some people don't want to pay on it for 30 years. They want to pay it down faster. They don't want to pay the extra interest. What I advise you to do is go ahead and get committed for the lower payment and pay in additional principal, and you'll pay it off faster. We talked about an additional payment, knocking 7 years off. Go to bankrate.com, play with scenarios of how much you can pay extra a month annually to pay it down. But I really advise you to get the most manageable commitment of cash flow and then pay an extra versus building in the highest cash flow, and it might get tough. We talked about PITI, put the M on there for mortgage insurance for most of you because you won't have 20% down for your total cost of housing. The qualifying ratios, the debt ratios, we talked about those, so we won't belabor those. And so Section 3, underwriting. Qualifying criteria evaluated. Now, lending, you'll hear about the C's of lending. Credit, character, capacity, cash. Okay? Your credit report tells you that. Your character, credit report is another. Your capacity, the debt ratio tells us what that is. Okay, so we've covered the calculations around the factors that we use to underwrite the risk of lending you money. And that's what those qualifying criteria are. Okay, income stability, we talked about that, the verification of employment. So we'll move through that. Do you have enough income? Again, your debt ratios will tell you. All right, so we'll move through that. The money to close. We talked about that and the verification of deposits. So the information disclosure, one of the things that you will sign in your when you apply for your loan is you'll sign the verification of deposit, you'll sign the verification of employment to be sent to your lender. The verification of deposit will be, well, verification of employment gets sent to your employer. Verification of deposits gets sent to your financial institution where you have your deposits. Now, if you're self-employed, you will verify your employment through verified financial statements, probably prepared by an accountant. Probably have to also verify it with your business bank statements and your incorporation papers as such, or your business license that shows that you are indeed self-employed, with your P&L, which is the equivalent of a VOE for the self-employed individual. Okay? All right. Moving right along through the underwriting and loan processing. Information disclosure authorization, a sample one that says I'm basically applying for a loan and I authorize you to give out information. You will sign a document that authorizes your lender to get information when you apply for the loan, and it will be sent along with the VOE and the VOM, VOD, because no one will release information about you without your permission, and for very good reason. Okay. The credit history, we talked about that ad nauseum. The 3 primary credit bureaus, the contact information, you can also contact them online. If you have a credit dispute, you can send it in the mail. You can go online and submit and upload it. I submit to you, though, if it's serious, I would do it in writing, and I would do it certified with the documentation, and be diligent about following up and sticking to and making sure that they meet the legal timelines as laid out in the Fair Credit Reporting Act. And so get your credit report, review it, make sure the information is correct, and follow up accordingly before you get into the process. Commitment letter. Once your loan is approved, you will get a firm commitment, which is different than a pre-approval letter. Pre-approval letter isn't pretty much worth the paper it's written on, because the caveat says I've looked at some information and says this person should be applying. A commitment letter is a commitment to lend. It'll be good for a specific period of time up until a specific date for a specific amount of money, and it'll lay out the terms. Commitment letter is a commitment. Pre-approval letter is worth very little. Credit scoring, we talked about that. Automated underwriting, that just represents the fact that today many times the loan is submitted almost always through an automated underwriting system that spits out a recommendation, and then the underwriter takes it from there. Letter of commitment, as I said before, it states the amount of the loan, it states the term, it states when it's for, and that is a piece of paper that does something for you. Now let's talk about fair housing. Unfortunately, we still have discrimination in this country based on race, national origin, sex, familial status, handicap, or disability, creed, religion, age. Discrimination based on any of those factors is blatantly illegal. We see it, it happens. There are agencies to address it. In your local area, you'll have legal aid, you will have a fair housing inside your city municipal government. They will have an agency that deals with discrimination in housing. And so you want to go ahead and be aware and report that when it happens. What is prohibited? Refuse to rent or sell housing based on the number of children. You see it based on family status. You see it based on origin. You see it, and it can be subtle. Refuse to negotiate, make housing unavailable. Oh, it's no longer on the market. And if you sense that you've been steered to certain places and away from where you want to go, let's take a look at redlining. What is redlining? Redlining is an illegal practice in lending, although the insurance companies get to do it readily, charge more if you live over here and less if you live over there. Well, banks aren't allowed to do that. Now, and historically what's happened is if you're in one area, you get a better type of loan. If you live in another area, and I've already said that even since the year 2000, from 2000 to 2010, we've still seen these issues in the marketplace. Caveat emptor, let the buyer beware, but understand that you are empowered to do something about it when you can identify discrimination, and we all need to continue to fight against it and provide fair housing. Okay? In addition, it is illegal to threaten, coerce, or interfere with your housing rights. Advertise or make statements that indicates a limited preference based on race, color, national origin, religion. You got to be pretty dumb to actually advertise that these days, but you might be surprised. Okay, and things that they cannot do: refuse your loan because of any of this. Refuse to provide you information regarding loans, impose different terms or conditions, discriminate in appraising the property, refuse to purchase a loan, set different terms. All of these things, believe it or not, continue to happen. Now, if you suspect that there is discrimination happening against you, you can contact HUD. You can also contact your local city fair housing anti-discrimination unit and get some action on it. Where to call? There's the contact information for HUD, HUD.gov, and you can follow up on housing discrimination. Okay? So just be aware that you have rights if you feel like they've been violated. The review quiz, we're almost done. Before we go to the quiz, I want to bring your attention to the checklists of information that's needed for your loan process. And here we see various and sundry information. You need information on the property. Your agent will help you, but and I won't go through all the items on the list, but most of these things you will accumulate as a part of getting the contract done. Then the information on your employment. We go ahead and have your W-2s, go ahead and have your tax returns and 30 days of recent pay stubs ready when you start the process. Also, we talked about if you're self-employed, you need your tax returns, you need an accountant's financial statements, and we'll go ahead and you can look at that list. But looks like a long list, but it's not that bad once you start gathering the information, and you're going to need it anyway. Assets, liabilities, your financial statement. Actually, one of the forms in the mortgage application, and it's in the back of the book in the forms, it'll show the residential loan application form, and that will one of the pages lists your assets, your liabilities. Another page lists your income, and another page, and so basically the knowledge about these things are actually built into the application process. Okay, so with that, go ahead and go back to the quiz, and we'll get ready to go ahead and do the quiz so that we can wrap up this short little session that we've had. Okay, quiz is on page 83, and let's go to that page and get ready for quiz number 2. So we can now, as we've said, there are plenty of opportunities for people to get the most out of this situation, and plenty of opportunities for people to be taken advantage of or to get a lesser deal. We talked about the fact that some do, some don't, and we want you to be in a position where you get the very best financing. So now we're going to transition, and we're going to go back through the quiz, and all
right, we're back again for another quiz. I'm sure you learned quite a few things in that section. And so let's walk through the questions here. Number 1, what is a VOE? Verification of employment. Answer on page 74. What are debt-to-income ratios? Why are debt-to-income ratios reviewed by the lenders on page 75? Of course, we talked about that to make sure that you have the sufficient income and cash flow to service the debt. What is a VOD, verification of deposit? Well, how is it used by the lenders? To verify that you have the money necessary to close and to get through the transaction. And also, and as we discussed, in many cases, they want to see that you've got adequate reserves. And so we won't belabor all those points that we've hit in detail. Next question, identify key information contained in a credit report. Boy, we beat that one to death. It's on page 77, and of course on the attachment that I've provided for you that lays out the credit report, questions and answers, and all the appropriate data and categories. Next question, high ratios increase or do they decrease the lender's risk? Well, by now you know that the high ratios increase the lender's risk because it represents the fact that more of your income is already obligated for existing obligations, therefore less space to take care of your mortgage payment. Key issue, and we talked about that at great length. Identify 2 things you can do to reduce your ratios. Of course, the ratio is a comparison of 2 numbers, as we discussed, the debt and the income. So to impact those numbers, you either have to change the debt and reduce it, or increase the income, or both. Only ways to affect the relationship between 2 numbers. Simple math. What do you do if you encounter discrimination. We talked about that. We talked about how to contact and pass that information along to HUD. We also talked about your local municipalities will have a fair housing unit. We also talked about the fact that you can contact legal aid to make sure that your rights have not been violated and that you have all the appropriate remedies. And of course, again, that's on page 81. What's the typical range of credit scores? On page 78, theoretically 300 to 900. We talked about the fact that the average credit score in America is around 720. We talked about the fact that we rarely see them over 800, and we talked about all the ranges in between. So now you're armed to talk to your lender, and you're armed to know exactly how much you can get approved for, but you're also armed with understanding the relationship between what you can get approved for and what you can afford, which usually aren't the same number. And we talked about the fact that it's your job to protect yourself by not letting someone sell you more than you can afford because you can get approved for it. So now you're armed and you can go talk to lenders and be in command of the situation and let them know that this is exactly what I want, how I want it, and therefore you are far ahead at this point of not only most first-time home buyers, but most buyers in the market in general. That's it for this section. I'll see you in the next section where we talk about closing. And of course, once you've done that loan application and you're ready, then you've got to get ready to go to closing and get ready for the documents. And that's what we're going to talk about in the next section. So I'll see you then.